As more homeowners in the U.S. struggle to keep up with mortgage payments and maintenance costs, new data shows the number of property foreclosures is steadily rising. According to property data from Adam, foreclosure filings rose for 6 months straight year over year. And as of August, the number of foreclosures, that was up 18% from the same time last year. Those numbers put the U.S. on track to surpass the roughly 322,000 total properties that went into foreclosure last year.
Mortgage delinquencies are still historically low because home values have gone up so much in the last 5 years. But early this year, they began to rise just on FHA loans, which are generally used by lower income borrowers. But now we're seeing something new. In May, a significant jump in the early stage category of all delinquencies. That's 30 to 59 days past due.
Think about the home you bought, the one you signed papers for, the one where you cried a little, or hugged someone, or just sat in the empty living room for a second before the furniture arrived. You thought the hard part was getting approved. You thought once you had that fixed rate mortgage locked in, your payment was set, safe, predictable. It isn't. Right now, millions of American homeowners are discovering that their fixed mortgage isn't fixed at all, that the costs attached to homeownership are spiraling in ways no one warned them about.
Again, delinquencies and foreclosures are still at very low levels, but as more consumers face financial challenges and as it gets harder to sell a home, which it is now, these numbers could get worse.
That the financial ground beneath their feet is quietly giving way. And the data coming out of the Federal Reserve, the Mortgage Bankers Association, and foreclosure tracking firms is not just concerning. It is, in the words of one senior economist, a signal that more households are being stretched thin.
They rose from 0.92% in April to 1.03% in May. Not huge, again, but an early indication of financial stress among borrowers. What's more concerning, though, is that these delinquencies were led by borrowers in the near prime, prime, and super prime segments. That is, the least risky borrowers with the highest credit scores. So that suggests that this short-term financial stress is possibly beginning to affect even them.
This is Bricks Market, and today we're going to show you exactly what is happening, why it is happening, and what it means for the housing market in the next 12 to 24 months. Before we get into the numbers, subscribe to Bricks Market right now. Hit that subscribe button. Every week we break down what is actually happening in the U.S. housing market. Not the spin, not the PR, the real data. Let's get into it. The number that should stop you cold. According to VantageScore, the number of households falling behind 1 or 2 months on their mortgage payments grew by 30.9% between January 2025 and January 2026. 30.9% in a single year.
Redfin is forecasting a great housing reset. The real estate brokerage projects that next year, income growth will outpace home price growth for the first time since the Great Recession. So people will have more money, right, to buy a house? Well, at the same time, Redfin predicts mortgage rates will dip closer down to 6%. Although, of course, for Gen Z and young families, affordability is still a tall mountain to climb. So what does this reset really mean for buyers, sellers, and the entire housing market moving into 2026?
Some people will immediately say, well, the percentage of delinquent borrowers is still small. It's only 1.14% of all mortgage holders. And technically that is true. But that framing misses what is actually happening here. 1.14% of 86.94 million active mortgage accounts in the United States is not a rounding error. That is over 1 million households who are already 1 or 2 months behind. And when you factor in those at the serious delinquency stage, 90 days or more past due, the number of troubled mortgages climbs to an estimated 1.5 million or more based on Federal Reserve data analyzed by LendingTree.
Texas homeowners pay some of the highest insurance premiums in the country, and rates are increasing by double digits year over year.
There were 3 bills introduced to address rising insurance rates. None made it to the legislative finish line. Mortgage companies require homeowners to have insurance protection, but right now, no protection for homeowners or those working toward the American dream from increasing insurance premiums.
Single-family homeowners with a mortgage today pay on average nearly $2,400 more a year for property coverage. That's up nearly 70% from 5 years ago.
And here is the part nobody is talking about loudly enough. Late-stage mortgage delinquencies, meaning payments 90 days or more past due, rose 18.6% in December 2025 compared to a year earlier, according to VantageScore. That growth rate is faster than for auto loans, credit cards, and personal loans, every other category of consumer debt. Mortgages, the thing Americans are supposed to pay first, the one payment you do not miss. That is the category deteriorating fastest right now. The Mortgage Bankers Association officially reported that the overall mortgage delinquency rate hit 4.26% in Q4 2025, up 27 basis points from the previous quarter and up 28 basis points from 1 year ago. Delinquencies rose across conventional loans, FHA loans, and VA loans simultaneously, every major loan type, at the same time. The hidden reason: your fixed payment isn't fixed. Here is the thing that is breaking budgets across America, and most homeowners did not see it coming. You have a fixed-rate mortgage. Your principal and interest payment does not change, but your total monthly housing payment, that changes every year because it includes your escrow, the portion of your payment that covers property taxes and homeowners insurance. And those two costs have gone completely off the rails. According to Cotality, escrow payments have surged 45% since 2019.
Let's get the insurance checked on. Even before we do any other due diligence on the home, that's the first thing during your option period that I'm telling my buyers to do, just to make sure they can actually afford the insurance premium. Insurance is going anywhere from 20 to 60% increases premiums year over year, and that's been consistent over the last 2 and 3 years.
In some states, it is dramatically worse. In Florida and Colorado, escrow payments have jumped between 55% and 57% in 2025 alone. In Florida specifically, property taxes jumped nearly 50% over 5 years. Now add homeowners insurance on top of that. Property insurance costs have risen 70% between 2019 and 2025, according to a Dallas Fed report. 70% in 6 years. The average annual cost of homeowners insurance is now $2,948 and projected to reach $3,057 by the end of 2026. That is roughly $254 a month just for insurance, before your mortgage principal, your interest, or your property taxes.
Home prices remain quite high. Even though the growth rate has slowed, they still are quite high. We're getting some relief from the mortgage market for home buyers, but in general, housing payments are taking up a larger share of income. We do expect to see some relief, and in fact, our 2026 housing forecast anticipates that we will see that mortgage payment share of income slip below 30% for the first time in several years, but it's modest. We're going to be down in the 29% range. So it's not a significant step forward, but it will be a nice step forward.
A Cotality analysis found that about 65% of escrow accounts in 2026 are projected to be short, meaning the money collected throughout the year will not be enough to cover the actual bills. When that happens, your lender sends you a bill for the shortfall, hundreds of dollars, sometimes thousands, due immediately or spread over the next 12 months in the form of higher monthly payments on a mortgage you thought was fixed. Chad D. Cummings, a real estate attorney in Florida and Texas, put it plainly to Realtor.com. Homeowners expect to pay a fixed mortgage, but rising property taxes and insurance premiums are uncapped. We are regularly seeing insurance renewals jump by thousands overnight. This can trigger delinquency even when the borrower has never missed a payment before. That is not reckless borrowing. That is not someone who bought more house than they could afford. That is someone who did everything right and still got squeezed out from underneath.
Encouraging, it's been a tough few years in the housing market because affordability has been out of reach for so many buyers out there. We've had this tsunami of not just high interest rates, but also really low supply. Part of that is people were locked into their homes. They basically didn't want to give up the great mortgage rate that they had. It's kept supply down, and we haven't built enough housing.
The two-tier crisis nobody wants to discuss. There's a data point buried in the Federal Reserve Bank of New York's latest household debt report that should deeply disturb anyone who cares about American communities. Borrowers in the lowest income zip codes have seen their 90-day mortgage delinquency rate surge from roughly 0.5% in 2021 to nearly 3% by late 2025. That is a six-fold increase in serious delinquency in 4 years among the most financially vulnerable homeowners in the country. Meanwhile, borrowers in the highest income areas are, in the words of the New York Fed researchers themselves, largely insulated from these pressures. The New York Fed's Liberty Street economics blog stated it directly. Financial distress appears to be deepening for households in lower income areas. The counties with the biggest jumps in unemployment also saw mortgage delinquencies worsen most sharply throughout 2025. This is not random. It is the predictable result of wages that have not kept up with housing costs that never stopped climbing.
In recent years, Wall Street giants and institutional investment firms, many of you are here, you've driven up housing prices by purchasing hundreds of thousands of single-family homes, and it's been a great investment for them. You know, the crazy thing is a person can't get depreciation on a house, but when a corporation buys it, they get depreciation. But homes are built for people, not for corporations, and America will not become a nation of renters. We're not going to do that. That's why I have signed an executive order banning large institutional investors from buying single-family homes.
As of late 2025, the typical mortgage payment consumed over 30% of median household income, compared to 21% pre-pandemic. And according to a Realtor.com analysis, to restore housing to pre-pandemic affordability levels, one of three things would need to happen. Mortgage rates would need to fall to 2.65%, median household income would need to rise 56%, or home prices would need to drop 35%. None of those things are happening in 2026, not one.
So compared to 12 months ago, housing affordability is somewhat better, but I think the key word there is somewhat. It is not easy at all to be able to afford a home. But a couple things have been helping buyers a bit. One of them is that mortgage rates are down almost a percentage point from a year ago, which helps make monthly payments a little lower.
Percentage of income, that debt load has mostly been manageable. High debt, but guess what? We can afford it. But now some of that is beginning to change.
FHA loans, the canary in the coal mine. If you want to know where the housing market is most fragile right now, look at FHA loans. The FHA delinquency rate hit 11.52% in Q4 2025, the highest level since Q2 2021, according to the Mortgage Bankers Association.
Brian, the mortgage delinquency rate, has been really low for nearly a decade. And aside from a very brief jump at the start of the pandemic before those government forbearance programs, it's now sitting at just 3.98% overall, that according to the Mortgage Bankers Association. Compare that to just over 10% back in 2010 during the subprime crisis. The mortgage landscape, I'm saying, is quite healthy, with one major red flag. FHA loans, their delinquency rate, while always higher, has been rising recently, now hitting 11.3%, and that is the highest since 2013.
That means more than 1 in every 9 FHA loans in America is in some stage of delinquency right now. FHA loans are the entry point into homeownership for first-time buyers, lower-income households, and borrowers with less than perfect credit. They are the most democratically accessible mortgage product in the country.
All of the stresses in life we're seeing right now, a little bit of softening in the job market. We're seeing big jumps in insurance premiums as a result of all of the hazards out there, whether they be wildfires, hurricanes, what have you. All of that leading to some stress.
And they are deteriorating fast. FHA delinquencies account for 52% of all seriously delinquent loans in the United States, despite FHA mortgages representing a much smaller share of the overall market. Those loans originated in 2022 and 2023 at elevated interest rates are performing worst of all. The pandemic forbearance programs have expired. The relief options have dried up, and those borrowers are now sitting with mortgages they can barely sustain in a cost environment that has gotten significantly more expensive since they signed those papers.
All of the hazards out there, whether they be wildfires, hurricanes, what have you, all of that leading to some stress.
FHA attracts first-time buyers with lower incomes and credit scores. The FHA down payment requirement is just 3.5%, and borrowers can carry higher debt compared to their income, that's so-called DTI. And that's because FHA borrowers have to pay mortgage insurance. But FHA recently lowered that insurance premium, which brought in more borrowers. That resulted in higher credit levels of the entire program, but that debt to income is still very high, and that's because of inflation and affordability, high home prices.
Foreclosures are accelerating. Let's talk about where delinquencies lead, because the downstream data is already moving. According to Adam's Q1 2026 foreclosure market report, 118,727 U.S. properties had a foreclosure filing in the first quarter of 2026, up 6% from the previous quarter and up 26% year over year. March 2026 alone saw 45,921 properties with foreclosure filings, 28% higher than March 2025. Foreclosure starts, the leading indicator that signals where things are headed, rose 20% year over year.
From 2020 to about 2023, home prices soared across Tampa Bay. Some families who bought their homes back then are now facing a harsh reality.
They would have to sell at essentially the same price they bought for because there has been a declining market. So they would need to bring roughly $10,000 to the closing table in order to avoid a short sale.
Bank repossessions climbed even faster. Lenders took back 14,020 properties in Q1 2026, a 45% annual increase. That is not normalization, that is acceleration. The worst hit states right now are Indiana, South Carolina, and Florida, where 1 in every 739, 743, and 750 housing units respectively had a foreclosure filing in Q1 2026. These are Sunbelt states, the same states that saw the most dramatic surges in insurance premiums and property taxes, the same states that attracted millions of buyers during the pandemic boom who paid peak prices and are now sitting in homes worth less than they were 18 months ago, locked into rates they cannot escape. In Florida, lender repossessions doubled year over year in Q1 2026, from 487 REOs to 1,014. Donna Schmidt, CEO of DLS Servicing, said the industry saw 5 years of very low foreclosure rates as forbearance policies allowed borrowers to kick the can down the road. Her warning to the industry, this is just the start. What comes next? Let's be clear about what the data does and does not say. This is not 2008. Lending standards today are far stricter than the subprime era. The median credit score on newly originated mortgages has remained above 750 since 2009.
It's been a rough few years for potential home buyers. Stubbornly high rates, low inventory continues to be an issue for many areas across the country. But we're seeing some signals that the stock market is finally easing. The latest Freddie Mac data found that the average rate on a 30-year fixed-rate mortgage did tick up to 6.3% on Thursday. Purchase applications are 20% higher than they were a year ago. And my next guest says that's not a surprise. She's seeing some definite green shoots in the housing market, including a reset underway in buyer behavior.
Homeowner equity is at historic highs, over $34 trillion nationally. Foreclosure levels, while rising fast, are still roughly 87% below the 2010 peak and well below pre-pandemic norms. There is no toxic loan bomb set to detonate the way subprime mortgages did in 2007. But what is happening is something different, something more insidious. This is a slow-motion affordability collapse, a market that is fracturing at the edges, hitting FHA borrowers first, lower-income zip codes first, Sunbelt buyers first, while the national headline numbers still look relatively calm. As Cotality's own report stated, what stands out this quarter are the differences emerging at the local level. While the national picture appears calm, nearly half of metropolitan areas experienced an uptick in overall delinquencies, serious delinquencies, and foreclosures.
It is such a bifurcated market. So it's bifurcated in terms of location, it's bifurcated in terms of the consumer. Now, to answer your question about buyer behavior changing, it's really changed. You're seeing buyers, they no longer have this FOMO. They're really entering the market with a lot of caution. They're being selective. But now you're really seeing what I call the comeback buyer. And these were buyers that were waiting for perfect conditions. And they're seeing that these perfect conditions, Cheryl, they don't exist.
The national average is a mask. Underneath it, the fractures are widening. One attorney quoted by Realtor.com said that as AI continues replacing workers and as employers give smaller cost of living increases, he anticipates delinquencies will rise sharply through 2026 and 2027. Job markets and mortgage delinquencies are tightly correlated. The counties that saw the biggest unemployment jumps in 2025 also saw the sharpest rises in missed mortgage payments.
Basically, this shutdown is a source of uncertainty in markets, and that helps drive rates higher, which of course is bad, or lower, which would be good to help kind of stimulate demand for mortgages. Right now, thus far, we haven't seen much of an impact on rates, but the longer the impasse drags on, the more the uncertainty rises, and that's just not good for rate stability.
What this means for you right now. If you are a homeowner, do not assume you are immune. Pull your escrow statement. Understand what your actual total monthly payment is, not just principal and interest. Know what your insurance renewal looks like this year. Know your property tax assessment. If you are feeling squeezed, call your mortgage servicer now before you miss a payment, not after. Options shrink dramatically once you are 90 days behind. If you are watching the market as an investor or a buyer, pay attention to where the distress is concentrating. Indiana, South Carolina, Florida, Gulf Coast, zip codes, markets where prices have already started declining and insurance costs have made the numbers on investment properties look very different than they did 2 years ago. And the headlines will tell you everything is basically fine. The national delinquency rate is still low by historical standards. Home prices have not crashed. The banks are not failing. But 2.4 million American homeowners are in some stage of delinquency or financial stress right now. That number is climbing at 30% year over year. Foreclosures are up 26% in 1 year. FHA defaults are at a 5-year high. The escrow payments that were supposed to be predictable just jumped 45% since 2019. Something is building in this market. The data is telling you what it is. The question is whether you are paying attention before it arrives on your street. That is it for today. Subscribe to Bricks Market if you want to stay ahead of what is actually happening in U.S. housing. Not the spin, not the press releases, just the numbers that matter. Drop a comment below. Are you feeling the squeeze on your own mortgage payment? Have your insurance costs or property taxes jumped in the last year? Tell us where you are and what you are seeing. We read every single one. See you in the next video.